Moving average envelopes can be used to identify strong moves that signal the start of an extended trend. The trick, as always, is picking the correct parameters, which takes practice. Trial and error. The chart on the screen shows Dow Chemical, Dow, with the moving average envelopes 20, 10. Closing prices are used because moving averages are calculated with closing prices. Some chartists prefer bars or candlesticks to utilize the intraday day high and low. Notice how Dow surged above the upper envelope in mid-July and continued moving above this envelope until early August. This shows extraordinary strength. Also, note that the moving average envelopes turned up and followed the advance. After a move from 14 to 23, the stock was clearly overbought. However, this move established a strong precedent that marked the beginning of an extended trend. With Dow becoming overbought soon after establishing its uptrend, it was time to wait for a playable pullback. Traders can look for pullbacks with basic chart analysis or with indicators. Pullbacks often come in the form of falling flags or wedges. Dow formed a picture-perfect falling flag in August and broke resistance in September. Another flag formed in late October with a breakout in November. After the November surge, the stock pulled back with a 5-week flag into December. The Commodity Channel Index, CCI, is shown in the indicator window. Moves below -100 show oversold readings. When the bigger trend is up, oversold readings can be used to identify pullbacks to improve the risk-reward profile for a trade. Momentum turns bullish again when CCI moves back into positive territory, green dotted lines. The inverse logic can be applied for a downtrend. A strong move below the lower envelope signals extraordinary weakness that can foreshadow an extended downtrend. The chart below shows International Game Tech, IGT, breaking below the 10% envelope to establish a downtrend in late October 2009. Because the stock was quite oversold after this sharp decline, it would have been prudent to wait for a bounce. We can then use basic price analysis or another momentum indicator to identify bounces. The indicator window shows the stochastic oscillator being used to identify overbought bounces. A move above 80 is considered overbought. Once above 80, chartists can then look for a chart signal or a move back below 80 to signal a downturn, red dotted lines. The first signal was confirmed with a support break. The second signal resulted in a whipsaw loss because the stock moved above 20 a few weeks later. The third signal was confirmed with a trend line break that resulted in a rather sharp decline.